If you're in your 20s, the money decisions you make right now will either set you up for life or cost you hundreds of thousands of dollars by the time you hit 40. And absolutely everyone has advice for you: parents, friends, coworkers. The problem here is twofold. On one end, the stakes are high, and on the other, while you'll probably run into some good advice, you'll also run into some suggestions that could seriously derail your financial future. Most people aren't equipped to tell you the difference between good advice and bad advice, and that's why today I'm sharing some of the best and worst financial moves you can make in your 20s. By the way, I'm Steve Reitmeister. I spent more than a decade as editor-in-chief of Zacks.com, and I'm currently a partner at WallStreetZen, where we help simplify fundamental research on thousands of stocks for everyday investors. By the end of this video, you'll have a much clearer idea of what actually moves the needles in your 20s, so you can stop guessing and start building your wealth. And be sure to stick around to the end, because the last one could save you a lot of money and headaches. So if you find this useful, hit the like button so I know to make more videos like this in the future. Okay, let's get started. First up, some good advice. Maximize your 401k match. This is the closest thing to free money that exists in personal finance. If your employer offers a 401k match and you are not contributing enough to capture the full match, then it's like leaving money on the table. So let's get that money back in your pocket. Roughly 1 in 4 employees do not maximize their employer match. On average, they leave about $1,300 a year on the table. That's not chump change. You take that figure, factor in a normal amount rate of return, and compound it over the decades that follow, and that's a life-changing sum of money that almost a quarter of people are simply missing out on altogether. Before you invest a single dollar anywhere else, before we discuss index funds, individual stocks, before anything else, please make sure to capture the full 401k match. It's an instant 50 to 100% return on day one, depending on the exact formula that your employer uses. And if it's available to you, then just like the Nike slogan, just do it. All right. Number 2 is a very common piece of bad advice, and that is to stay out of the stock market because it's too risky. Just another form of gambling, and this is simply not true. Listen, I understand why some people might be wary of the stock market given how volatile it can be at times, but there's a right and wrong way to approach it to make it work for you. Not all stock investments are the same. If you're buying meme stocks based on a Reddit thread or putting your rent money into options, then yeah, that's kind of like gambling. But if you're buying into a diversified index like the S&P 500, then you are essentially buying a piece of the entire American economy. Writing out the highs and lows, the S&P 500 has returned roughly a 10% average annual return over the long run, pretty far from rolling the dice at the casino. The stock market only feels like gambling when you don't understand what you own or how long you're going to be in those positions. And if you're picking individual stocks and it feels intimidating to you, then that's not a reason to stay out of the market. That's just a reason to use better tools. A perfect example is the Zen rating system at WallStreetZen, where the computers do the heavy lifting to help pinpoint the best stocks. All in all, the Zen ratings analyzes over 4,600 stocks every day across 115 different fundamental factors, then distills that down to an easy-to-read letter grade A through F. And just like school, we want a report card filled with A's. That's because the A rating tells you is in the top tier of stocks we track based on the strength of its fundamentals. That's why A-rated stocks have historically averaged over 32% annual returns, while B-rated stocks have delivered an above-average return of over 19%. Stocks with this type of backing are a lot different than random penny stocks you find on Reddit. Here's the bottom line. I don't recommend avoiding the market if you want to have anything resembling financial freedom later in life. You simply need a better way to pick the best stocks, and the Zen Ratings is one such way to accomplish this important task. Moving on to number 3, get good at negotiating your salary. This is amongst the most underrated moves on the list today. Most people in their 20s spend more time negotiating the price of a used car than they do negotiating with their employer. And that's a grave mistake with long-term negative effects. Your raises, bonuses, and any future job offers will likely be anchored to the figure you're making at the time. A $5,000 difference in your starting salary when you factor in standard annual raises compounded over your 35 to 40-year career can translate into literally hundreds of thousands of dollars in lifetime earnings. Again, hundreds of thousands of dollars. All that from one conversation you were too nervous to have in your early or mid-20s. The worst they can say about your request for more is simply no. And even then, you've signaled to your employer that you know your value and might get more the next time around. Piece of advice number 4, focus only on savings, not investing. I give a big thumbs down on this piece of logic. Okay, let's start with what's right about this. Saving is generally important. Building a financial cushion is the foundation that everything else sits on. If someone in their 20s is saving consistently, that's a habit that pays off handsomely over a lifetime. But let's read the fine print, because savings is only step 1, not the finish line. A lot of people in their 20s were told to save. It did exactly that, and then watched inflation quietly eat away at the purchasing power of every dollar sitting in those tame savings accounts. Money that isn't growing is losing ground. Your emergency fund belongs in a high-yield savings account where it's at least keeping pace with inflation. Everything beyond that needs to be invested to achieve higher rates of return. Sitting on a pile of cash and calling yourself financially reasonable means you've done the easy part. Now finish the job. Before we keep going, if you want more videos breaking down investing strategy without the noise, then hit subscribe and ring that notification bell. It helps me out and it helps you see my new videos immediately after they release. Moving on to number 5, open a Roth IRA in your 20s. This is good advice. In fact, the math here is so good, it almost sounds made up. If you start contributing $6,000 a year to a Roth IRA at age 20, and assuming 8% average annual returns, by the time you're 65, you're looking at somewhere around $2 million saved up. Start those contributions 10 years later when you're 32, and you end up with less than half that at $900,000. Same contribution, same return, but a 10-year head start is worth over $1 million. And here's what makes the Roth specifically powerful in your 20s. You're paying taxes on your contributions now, when your income and your tax rate are probably the lowest they'll ever be. Every dollar that grows inside of the account comes out on retirement completely tax-free. Not partially, not mostly, completely tax-free. File this piece of advice under the essentials. It's a downright necessity. Rolling on to number 6 piece of advice, pay yourself first. This is solid advice. It's an incredibly simple concept, but it can have a massive long-term impact on your finances. If you haven't heard of this before, let me share what that means. The moment your paycheck hits, a predetermined percentage goes straight to your savings accounts and into your investments before you ever see it. Before bills, before anything, directly into your savings. The reason this works is that you can't spend what you don't have. Doing it the other way around leads to a lot of frivolous spending on clothes, eating out, entertainment, leading to nothing left to invest at the end of the month. But the money is already tucked away before you've had a chance to touch it. Your spending ratchets down naturally. Okay. Automating this single move is one of the most reliable separators between people who actually build wealth in their 20s and people who wonder where all their money went. It also leads to greater rainy day savings, earlier retirement, and overall long-term financial stability. As for number 7, that is the idea to go all in on building a business instead of investing. That idea has kind of mixed reviews. The loudest voices telling you that you need to start a business in your 20s are too often selling some kind of course on how to start a business. So they are talking about an idea that benefits them perhaps more than it benefits you. The reality is that many wealthy people you'll meet in life do not run a business. They have solid income from their jobs. They invest consistently. They avoid lifestyle inflation, and they let compound interest do the work over a long period of time. That's the most reliable path. It's not glamorous, but it does work time and time again for a wide range of people. Now, if you're generally passionate about building something and you have a real edge, then by all means follow your passions, meaning that entrepreneurship is a legitimate option, but only for those with the unique skills and mental fortitude to go down that more cumbersome path. Now, here we come to the halfway mark on our list today with number 8, and that is to invest consistently in index funds. This is good advice. The concept is simple to execute with solid results. The S&P 500 has roughly generated 10% annual returns over the long run. Money invested roughly doubles every 7 years, all without you having to pick stocks, time the market, or find the next big thing, right? Just consistently put your money and leave it alone. If and when you want better than average returns than the indices, then you can consider individual stock picking. That brings us back to point number 2 in having a better system for stock selection like our Zen ratings. If not comfortable going at it alone, then consider my Zen Investor stock picking newsletter, where I hand select the best high potential stocks. Just scan the QR code to find out more. about the Zen Investor and my top 20 stocks right now. As for number 9, the idea is to hold on to your losers and only sell when you get back to break even. This sounds smart on the surface, but is actually quite dangerous and quite stupid. I'm not talking about, little 5 to 10% drops here. That is just market noise. We're talking about 15% plus drops often caused after an earnings miss. In this case, the bullish thesis for owning the stock is gone. That's because an earnings miss is a sign of failure that too often repeats down the road, turning small losses into huge ones. Thus, hoping and praying to get back to break even on a broken company is one of the most expensive, emotional decisions an investor can make. The price you paid is not information the market knows or cares about. It's only your ego preventing you from making the right decision. Now, here's a good test of whether to hold or sell. Just ask yourself, given everything I know today, would I buy this same stock? Most likely the answer is no, making it all the easier to sell and rotate your money to a better choice. And if you're sitting there wondering what to rotate to instead, that's exactly why you should get my new free report, 3 Stocks to Double This Year. Claim your copy now with the link in the description, or just scan this QR code. Number 10 is one most folks will agree with, and that is to use dollar cost averaging for your investments. This is where you invest a fixed amount of money on a regular schedule regardless of what the market is doing. You stop trying to time things. You remove emotion from the equation. Just consistently add to the market, rain or shine. This is the most commonly used by passive stock index investors, just bit by bit adding to their portfolio and net worth over time. And it kind of goes hand in hand with the first point about adding to your 401k every month, especially when your employer is giving you free money. Now let's consider number 11. Buy assets instead of liabilities. The logic is straightforward. An asset puts money in your pocket over time, whereas liabilities takes money out. We've already discussed assets like stocks, index funds, but also that could be to invest in your education, to acquire new skills that raise your compensation over time. Whereas liability is just money flowing out the door, a fancy car that depreciates every single day, designer clothing and overpriced meals, or that boat that you only use 4 times a year. It's all like sugary chewing gum. It feels good for a short while, then quickly loses its flavor. The shift in your 20s that changes everything is when you start evaluating purchases through this lens before you make them. Not every purchase has to be an investment, but the earlier you choose assets, the more money you have for your lifetime of enjoyment. Number 12 is widely agreed upon logic, and that is to keep your finances completely private. You can talk about your health, your relationships, your career anxieties, but the moment someone asks what you earn or what you have saved, it feels invasive, almost inappropriate, like they're crossing a line. Unfortunately, the social norm is actually costing people, because the single fastest way to improve your financial situation is to be around other people who are better at it than you are. Not necessarily to copy them, but to calibrate what to do versus others in your peer group. Like to hear how someone navigated paying off debt while still investing, or to realize that the thing that you thought was impossible is something your coworker figured out about 2 years ago. If you opted out of these conversations entirely, you're building your financial life in an unnecessary information vacuum. Allow yourself to talk about money. Of course, you should be selective about who you talk with and the level of details you're sharing. But in general, the more you talk about how to handle money, the better your decision making is likely to be. As for number 11, it's a bit controversial, and that is the advice to completely avoid using credit cards. Yes, a lot of people generally get into trouble with credit cards. That's because the average American carries thousands of dollars in credit card debt at interest rates of 20% or more. For those people, staying away is generally the right call, but avoiding them entirely isn't necessarily smart. The tool isn't the problem. Discipline is the issue. If you pay your balance in full every month and you use rewards quite intelligently, you're essentially getting a discount on everything you buy. Points, cashback, travel rewards, it's real money available to anyone who treats their card like a debit card with benefits. The move isn't never use credit cards. It's knowing yourself and having the discipline to use it correctly and pay it off monthly without exception. If you can't, then maybe best to stay away. All right, number 14, avoid lifestyle creep. Imagine you get a $500 per month raise. Unfortunately, a few months later, your expenses have magically risen by $500 per month, wiping out the full benefit. New car lease, better apartment, nicer restaurants, and yet your savings rate is exactly the same as before the raise. You made more money and have nothing to show for it at the end of the day. Every raise you get in your 20s and 30s is a leverage point. These are opportunities to accelerate your investing without feeling any real pain because you haven't built your lifestyle around that money yet. The people who consistently treat raises as investing fuel rather than lifestyle upgrade changes are the ones who hit their 40s with serious wealth. That's not to say that you have to live like a monk. It's okay to enjoy some of the fruits of your labor, so long as you have a clear plan to set aside a significant portion of your new earnings for the purpose of investing. Avoiding excessive lifestyle creep is a solid choice. Only 2 more to go as we tackle number 15, and that is get invested early and stay invested. And this is an absolute yes. The data on this is crystal clear. If you had been investing in the S&P 500 over the last 20 years but missed just the 10 best trading days, your total return would be cut in half. Yes, just 10 days out of 5,000 made that big of a difference. Nobody times the market perfectly. Not any retail investors, not professional fund managers, not Steve Reitmeister, not any of the people on financial television who speak with total conviction they know what will happen next. No one has that form of clarity. In fact, most of those top 10 days happened in the midst of bear markets where many investors were scared out of the stock market. Timing the market is a fool's errand and just far too costly. The move that consistently wins is simply get invested and stay invested. Final bit of advice to evaluate today is number 16, and that is to build multiple income streams. Because if you only have one, it kind of makes things a lot riskier in your life. The concept itself is generally valuable. Don't just have one job to pay the bills. Also consider dividend income from stocks or rental income from property, plus some side hustle to add more to your monthly income. Dividend income in particular is one of the most underrated wealth building tools for people in their 20s. Building positions in fundamentally strong companies early is how that income starts compounding quietly in the background while you're focused on everything else. At WallStreetZen, we have several pre-built screeners dedicated to finding dividend stocks. Even better is our market-beating income stock portfolio inside our Zen Strategy service. It updates daily the top 7 income stocks ready to outperform. You can scan the QR code to learn more about this income portfolio and our Zen Strategy service. But on the topic of multiple income streams, there's kind of a read the fine print aspect here. That's because the majority of discourse about this stuff online has been hijacked by questionable sources. Multiple income streams has become a content category almost entirely designed to sell courses and coaching programs and drop shipping guides. Most of the people telling you to build 6 income streams are actually making their money from the course on how to build those income streams. Pulling back to the big picture, the idea of multiple revenue streams is solid, but the way it gets packaged and sold online usually isn't, so proceed with caution. Again, that's the full list of 16 pieces of common investment advice. Now, I want to hear from you in the comments section below. Let me know the best advice on the list today, and was there anything that you disagreed with? Share it all down below for the benefit of our community. Now, if you want to go deeper into the investing side of things, check out the video that's popping up on your screen right now. In there, I break down the best methodology for finding stocks for serious investment.